Welcome back, everyone, to Vox Markets. My name is Paul Hill, and I'm delighted again to be able to speak to CEO Jerry Randall of Venture Life Group, a leading consumer healthcare products firm. So, welcome, Jerry.
Hi, Paul. Nice to see you again.
Yeah, well, we've had some pretty big wobbles on the markets
Absolutely, yeah.
yesterday, but big congrats anyway on the positive first half trading
Thank you.
update today and the positive outlook. But before we sort of run through those details, I don't suppose you could quickly remind the audience of the company's sort of key USPs and longer term what the company is trying to achieve.
Yeah, sure, no problem. So Venture Life's in the consumer healthcare category. It's a strongly growing category. Self-care, which is we're all getting involved with now, which is about choosing your own medicine, paying for it, and using it on yourself. So we're in that category. What we've done as a business is to grow an operational structure where we are vertically integrated. So we go right from being able to innovate with ideas around products, develop them, produce them, manufacture them, and then commercialize them around the world. So for our size, just over 50 million of revenue last year, we are vertically integrated, which is quite unusual. And the real key to that operation is that we've got capacity within that operation. So what we're looking to do is to grow our existing products brands organically, and that's by obtaining new listings, new distribution agreements, and growing the products there with our advertising and promotion. And secondly, by acquiring and integrating interesting new products into our business, which again, we can internalize the manufacture, we can develop, and we can expand the geographic and distribution footprint. So it's all about good margin products, high cash generation, getting good cash off the bottom, using our revolving credit facility to make acquisitions within sensible leverage, and then paying that back down quite quickly with high levels of cash generation.
Yeah, well, that came through pretty strongly, I think, in the first half. Now, can you just take us through sort of a bit of the color on the sort of the sales, the top line? Because I did notice that overall it was flat at £23.5 million for revenue in the first half, but split between 5% up for your own higher margin products and then 7% down on third party brands.
Sure, sure. So the if we go to the third party sort of customer brands first, that had a particularly strong first half last year, and we had a couple of our bigger customers who increased their stock holdings quite significantly in the first half of 2023, and that gave us strong sales in that part of the business, which we're not going to repeat again this year because that was people building up stock for certain reasons. So what we've seen is a reduction in the overall revenues in that customer brands, but we'd expected that and we anticipated that back to the levels that reflect sell-through rates. That said, within that business, we signed a lot of new customers this year, and you'll see the benefit of that in the second half, and we can talk about that a little bit later. If you look at the UK business, which has grown very well, 5% like-for-like sales growth, just over 1% of that has been in price and 4% in volume. So again, we're still driving volume growth and not just sort of price increases. And it's really across our three main brands. So if you look at the Venture Life brands overall, Balance Active 9% up overall, UK is 14% up compared to last year. That's really new listings, the launch of the thrush cream, and then on the international side, some new partners coming through. Lift is 30% up. That's mainly UK business, and that's growth online where it continues to grow very strongly, and increases in distribution. That range is now listed in Tesco's, Sainsbury's, where it wasn't before.
And
And the near roll,
why has it been
okay,
so strong in the UK? Because obviously you've seen a huge jump, the good strong double digits.
yeah, yeah.
Yeah.
I mean that's really down to our advertising promotion strategy. All of our AMP is digital now. So we use TikTok, Instagram, social media, and we've just had a big push there on Lift, pushing it out in terms of different user groups and expanding the range. You've got new flavors, you've got new products in there. So combination of all those things, and the digital social media has been a really strong driver for us, and that's contributed to the growth online. It's a product that sells very well online. It's a good subscribe and save product. It's a good repeat use product, so works really well online. So yeah, it's performed really well, and big credit to the brand team and who've been working behind with the advertising, and obviously getting new distribution like listing in Sainsbury's is really important as well.
Mm. And that
And finally, I'd say ear roll as well. 13% growth this year. That includes the Vaxel brand internationally, but that's online where we put the products online for the first time back end of last year. New listings, annualizing, which was listed in Tesco's last year at the end of the year, and now that's annualizing. So again, it's the sort of annualization effect of new distribution gains from last year.
Yeah. And has that inventory normalization for the third party brands, has that run its course through now?
Yeah, and when I say inventory normalization, that's really the fact that they took a lot more stock in that
Mm.
period last year than they would normally take, and the customers involved had different reasons for it. But it meant that they took more stock than their regular level, and that's why last year the customer brands business had a strong year.
Yeah. And I guess that now the mix has is increased, hasn't it, between sort of like your own brands and the third party, and presumably that's had a flow through into your gross margins.
Yeah, it has. Yeah, I mean, I think what I'd also add on that sort of UK piece is we saw 20% growth in Ultradex H1 this year compared with H1 last year, and that's really around promotional activity. So that again, as a better margin product, being contributing, and I think that mix of those higher margin products, as you say, is improving gross margin, and that's a theme in the second half as well, because a lot of that increased revenue that will come through in the second half of the year is on our brands business,
Mm.
particularly on the international business, some new listings, new products, and they're all the higher margin products which are giving us that flow through. And that gross margin improvement, of 1%, year on year, again, is coming through principally through a combination of blend and also supply prices starting to normalize and be stable, because we had a lot of inventory last year that was used to manufacture things that was bought at the higher prices at the peak of the supply chain pressures. So that's washed its way through now, and we're now seeing an improvement in the margin, partly because of those supply prices normalizing a bit more.
Good. And then you just talk through the sort of the strong cash generation, what's been sort of happening there, because I saw your net debt's reduced by £3 million to 10.7 million. So good 21% reduction in 6 months. That's going a
Yeah.
bit.
Yeah. I mean, as you know, when we bought products in the past, we've targeted sort of high cash generation products, and Earol was a really good example of that. It was over 90% cash generation business. So we've made sure we're tight on working capital. We've made sure that our operational cash flows and debt collection is strong, and yeah, it's just profitability converting into real cash flow, and that will continue in strength in the second half and continue to reduce our net debt.
Mm. And then just talking on that second half outlook, obviously this top line sales were sort of flat for the first half, and you're looking for around about 12-13% sort of like for growth in the second half. Can you just talk
Mm.
through the sort of the visibility of that?
Yeah, I mean, that comes from two or three places, really. So we have an order book over sort of 70% of our business, that part of our business outside of the UK. So brands and customer brands outside of the UK, that's an order book. People order it, it's made to order. So we have good visibility from that. So we can see what's coming. Also, again, further new listings in the first half of the year, which will, start to annualize in the second half. A big part of the business on international is coming through in the second half. That's always weighted towards the second half, lots of NPD. And then even if you look towards, the bottom line, we've got cost of goods improvements, supply prices coming down a bit more. That's helping. Also, we're internalizing the production of Aerol in the second half of this year. A lot of that production will go through our own plant, and that's giving us incremental profitability savings on the cost of goods as we go through. So it's a combination of all those things. And, some nice new deals signed internationally in the first half of this year, like Jaguar Health, that will land in the second half of the year. So there's a number of things that are contributing to that stronger second half. And as any of our shareholders and investors will know, we always have a stronger second half than
Yeah.
first half, driven a lot by the partnered business as opposed to the UK, which is a bit more regular on a month by month basis. So it's just what we've seen in previous years, and expect that to continue this year.
Mm. And I guess that strong second half is a real milestone in terms of bringing the net debt down to sort of below were 0.8 times EBITDA, which is terrific considering you were closed last year at 1.3 times.
Yeah, absolutely. I mean, it's a real focus for us, as I said, in the acquisitions, the
Mm.
things we buy and the way we run the business, that we maximise the cash generation coming up. And don't forget, we're also investing in medical device regulations. We're investing in the factory. We're investing in new product development. So, we're even developing or delivering that net debt reduction whilst investing in the business at the same time. So, the cash flow is good, and that's all down, to the way we run the business, to the way the finance team manage the working capital. Really important that we keep inventory days to the right number, make sure that we don't sit on obsolescent stock and those sort of things. So there's a lot of work goes on behind the scenes in the supply chain and finance team to make sure that's, we run a tight ship there.
Yeah. And what's the sort of background of bringing the Earol production in-house?
Yeah, well, it's always a strategy with anything that we acquire, because ultimately we've got a very good manufacturing base, both in Italy and Sweden. We've got capacity there. And bringing it in-house does two things. It improves our working capital because we're buying raw material and packaging rather than buying finished goods. Improves our margin because obviously we're internalizing that profitability margin, and it improves our ability to develop new products and integrate them into our manufacturing business. So anything that we buy, that will always be our intention ultimately to internalize the manufacturing where we can.
Yeah. Well, it's great to certainly to hear sort of like long-term visibility and strong cash flow in these wobbly times over in the market. That's exactly what we need. So, and just in terms of news flow, is the interims are presumably going to be towards the back end of September, are they?
Yes, that's right. Obviously, the interims will give more color around that revenue breakdown.
Yeah.
Where the sales are, the initiatives that we've been doing, where the A&P has been spent, and we can elaborate a lot more on it. Then, obviously, we'll talk a bit more about the cash generation, where that's coming from. But I think what you should also look for, and perhaps not by September, but by perhaps during the course of this year, is we're really interested to continue our M&A program. The last couple of years, it's been very difficult for us to do that. Share price has been too low to raise money, and it probably still is now. We've had a level of debt, and obviously, as you know, shareholders have been really uncomfortable about carrying any level of debt over that period. But I feel that sentiment is starting to improve. We're reducing our net debt quite significantly. As you say, down below one. By the end of the year, and that's through the cash generation. And there's some really good opportunities out there. So, we're really keen to continue to look at M&A because that's something we've built the group on. And going back to your question at the start, what's the long-term vision of the business? Well, that's to continue to grow and develop interesting brand assets in this healthcare space. Europe's a fantastic, sort of playground, I suppose. There are very few true consumer healthcare global brands. It's much more about local heroes. We've already got some great local heroes. Balance Active, the number one BV product in the UK. Earol, the number two, etc., etc. So we want to build on, have more of those interesting local hero brands that we can then exploit internationally. We can make ourselves, we can develop into them. So, continuing M&A is really important. If you look back over the last 10 years, our compound annual growth rate of over 20% has come, half of that's come from organic growth and half of that's come from acquired growth. So we want to continue to do that. So that's very much in the vision of the future, to become a bigger, more profitable consumer healthcare company. And what you'll see is gross margins improving through that as the branded part of our business becomes bigger. Also, as supply prices become more stable, and then finally, with limited operational gearing, it means that increased margin will be dropping through and accelerating our EBITDA percentage as well. So we'll see all those tracking forward over the coming years to to a really exciting, very cash generative business.
And I think the company refinance its facility with the HSBC earlier in the year. Was it called Q1 or?
Yes, it was. Yeah, it was just at the start of Q2 because it was just after our results came out. But so Santander and HSBC Innovation are our two funding partners, and that's a 30 million committed facility with a 20 million additional accordion. It's renewed now for 3+1. We definitely want to use that. And there's no doubt as well that once our share price gets to a perhaps more appropriate level, we'd be keen to use equity to fund part of our acquisition strategy as well.
Yeah, well, it's nice to say to have a safer harbour in stormy waters, that's for sure. So thanks very much.
Yes.
Thanks very much, Jerry, and I look forward to touching base again in September for the interims.
Great, thanks, Paul. Thanks for your time.